right. That was very dramatic. I love it. All right. Thank you guys so much for being here. I'm really excited to have this conversation. We're going to get into where the smart money is going in 2026. And we're going to be so time efficient. We're going to demystify everything in 18 minutes for you guys. So let's start by setting the stage. We're in the middle of this huge AI boom right now. Everyone that's doing anything is AI. Where in the cycle are we? Are we somewhere in the middle? Are we coming to the end? Is there a lot more to come?
When you say coming to the end, do you mean like, is it all about to be over?
Yes.
No, I don't think so. Pretty early. I mean, I think the shift that's going on is from, what is it, 1% of the world that's actually using these tools to that's going to be much more mainstream. They're going to understand what it can do for them, the impacts, and we're going to shift from, sort of a chat-based understanding of AI to the actual implementation of intelligence more broadly. So I think we have a long way to go. It's a major shift in innovation. It's the second big one of my life. I'm hoping to see quantum also. It'll be the third big one, but I think it sort of changes everything over a very long arc.
Yeah, I think we're super early. I think society will be transformed dramatically in some good ways, some bad ways, and all of that is ahead in the next 20, 30 years. It doesn't help me figure out how to invest directly. So if that's where you're going, yeah, we can talk about that.
Okay. Part of the theme of our conversation is the fight to quality. What does it actually look like today when you're meeting new startups, you're looking at what they're up to, you're evaluating investments? What does quality look like?
Want to go first on that one?
To me, quality looks like gross margin. I am really, really surprised, and that's why I hesitated a bit on where in the cycle we are. I'm really, really surprised at how many companies in that middle layer, the AI producing layer, so not the lowest layer of infrastructure and not the highest layer of applications, but in the middle layer, which is the AI producing machinery, how many companies have negative or very low gross margins. So I'm sure you're thinking, when you say flight to quality, you're thinking OpenAI, Anthropic, et cetera. They all have poor gross margins. So at this point, I'm not sure what the flight to quality there is. And VCs, most VCs have a software mindset, so we're thinking about the software stack. And I'm not sure exactly where the quality is without going lower and lower. So I do a lot of infrastructure software. There's still some gross margin there. And there's a lot of gross margin at hardware, NVIDIA, AMD, Broadcom, all of those companies. So as I look for quality, I go lower down in the stack. I don't go higher in the application area because although there are some really interesting opportunities there, AI is getting better so quickly that that top layer might get disrupted by the middle layer.
Fair.
I would say context matters a lot, and that's not just like an AI dad joke. Like it actually, for us, like I'm investing very early stage, right? And so pre-seed, when you talk to me about focusing on quality, right? I'm still investing in lots of founders and lots of places, hundreds of companies a year, and I'm doing it at very early stage, right? And so I can afford to maybe take some more risk on things, and I'm very focused, and I think Techstars overall is very focused now on spaces and verticals that are less attackable by a 15-year-old with a laptop that can come and just copy some software. The software is not the special thing anymore, right? In fact, we're kind of coaching all of our companies, hey, you should be willing to just give away your source code, right? Just publish it. Don't do that with your database. That would be crazy because data is an asset. But someone can see software and copy it. And so, when we're looking for quality, it's now, well, what vertical are you in that maybe wasn't so sexy a few years ago, and now hardware, is a thing again that maybe is interesting. Physical connection to the world, AI can't touch that as easily. You're thinking about industries like space, where access and regulation, matters, or healthcare, where, very proprietary collection of data and the loop around that matters a lot. And so, quality is going to depend on the stage you're looking at. And we were chatting backstage, I think there's an enormous opportunity right now for individual people who understand this technology to go and make plenty of money and do something, that is really just a thin wrapper on AI, which investors don't want to touch, but is a huge opportunity for an individual in the next couple of years to go and monetize. So I think the context of where you're investing matters a lot.
So let's dig into defensibility. Where do you guys think right now in this AI boom, where is that? Where are the moats? What can you actually defend as a startup?
Yeah,
Well,
I'll jump in if you want.
yeah, in the top layer. By the way, when we were chatting backstage, we were saying, "Did you pick this title?" Because I didn't pick this title. It's a little bit of a presumptuous title. But in the application layer, so not infrastructure, not the model layer. My framework is to ask 2 or 3 questions. First one is it forms on top of a database? If it is forms on top of a database, it's not great. Not all is lost, but it's not great. We can come back to that. If it is forms on top of a database, so if it's not, then I think you're good, because you're probably doing something lower. You're probably not application software. You're probably infrastructure software. But if you are, then the next question is who does the data belong to? It might be your data, but does it belong to you? For example, your driving data in a Tesla belongs to Tesla, not to you. But your data in Salesforce belongs to you, and you could export it. So then on the data part, how much data is there? How hard is it to manage it? Do you need Salesforce? Let's take the example of Salesforce, which is forms on top of a database, but it's a system of record, so it's hard to migrate away from. Why is it hard to migrate away from? The data has a lot of knowledge about the business of sales, about what opportunities mean and what contacts mean and how they can or cannot be related to each other. So that's worth something. So that makes it a little bit hard to take all your data out and have your own database and then have agents work on that data. But it's not that hard. It's a little bit hard and it's extremely inconvenient, but it's not that hard. There are other types of data and schemas that are much, much harder. And there are other data that's more valuable and more voluminous. So I think that's probably the key. You ask that progression of questions, and if some of those are green check marks, then maybe there's something there. Otherwise, it's under attack by AI.
Yeah, that kid with the laptop, right? It again, hard to attack. Something that has a physical connection to the world, something that requires you to be in a particular place and touch and engage with something, something that creates a proprietary data loop, right? There aren't a whole lot of areas that are defensible, and that's the challenge. I think humans in the loop is a misunderstood one. It doesn't mean just throw people in there for no reason. It means if you've got a collection of people that are really important to a process, and you then enable that as a service, that's going to provide value for people. If you've just got software, it's probably going to be easy to compete with. And so I think what you're trying to do is configure that in a way that is no longer this sort of pay per seat model, right? I think that's kind of like a suicide pact for a startup to go with a pay per seat model in the future. It's going to be pay for performance, pay for success, pay for utility. Yeah. We're so used to this environment where we're creating software to distract us and take our time, and now we're shifting into a new mode, which is to create software that you don't even have to see, that you don't even have to engage with, that can save you time. And that's a better mode to be in, I think. And so I'm excited about it. But yeah, defensibility is going to require some of those assets, like clearing those regulatory hurdles, being in difficult, hard tech, space, defense, things like that. and having some sort of data asset that you're building that you can really prove instead of just saying, yeah, I have a data asset, which is what we see a lot in pitches. Show me what that data asset is. Show me how it's compounding over time.
How do you guys feel about the idea that, those specialized models, for legal work or medical or anything like that, do you think that's defensible or not really?
I worry because you see every 6 months, the sort of core technology is getting so much better and destroying entire swaths of startups. Again, I think if it's doing something as a utility, as a service that you can't get, I think there's value there. I think, the LLM race is being fought with an awful lot of money, right? I mean, that's where the money is pooling, and it's being fought in really one place. That's very strong at that. And I think that's going to be hard for people to compete with. Rather than building the next LLM, I think it's how do you build the service around that actually provides value to people and charge for it that way.
So what does that look like?
I think it looks like an agent that you never see that consumes that capability to get something done for you that you used to have to do. It's the actual application. I feel like that's the mode we're moving into. Is we've poured a lot into creating this incredible technology and this intelligence that will continue to get better, driven largely by a few. And then I think entrepreneurship now becomes about how do we use that new capability of intelligence to deliver actual value downstream. And that's happening everywhere all over the world. It's going to be happening for probably the next couple of decades at least.
Salil?
Yeah, I think he covered it well. I think the lower you go, the easier it is to rationalize opportunities as a business, because AI is going to be a very good customer of infrastructure for the next 20, 30 years. So anything AI needs, so that's racks and machines and chips and power and cooling, like all of that feels like it's going to be good. I'm still trying to figure out how durable various aspects of that are. I mean, is that going to last forever? How long can that AI producing machinery remain at low or negative gross margins, and why is that happening? Normally when something has low gross margin, like a carrot slicer on Amazon, there's a reason for that. It's not because it's a bad product. It's because it's not differentiated enough. It's not unique enough. It's replaceable, and AI is behaving like that now. OpenAI, Claude, whatever, DeepSeek, open source models are 6 months behind. Surely that can't be a permanent state of things. Something has to change. So I'm waiting for that change. But meanwhile, anything that AI needs is a good business.
I was wondering where you're going to go with that carrot slicer thing. That was good. Yeah, I wasn't sure for a second.
You like carrots?
You actually mentioned when we chatted last week that you've had to move away from a lot of software because it's under attack from the LLM giants, and you're getting into a lot more hardware. Tell us about that journey for you as an investor.
Well, I feel like I'm forced to do it a little bit. I used to be, so I got a bachelor's and master's in electrical engineering, and then I never did hardware after that. I became a software engineer and then a software investor. So it's been strange that I'm having to dust off some electrical engineering and hardware knowledge to at least try to sanity check some ideas. It's been fun, so that's been, it's been rewarding. I've made half a dozen hardware investments now. I have a company that makes a chip that lets devices communicate through your skin at 2 to 4 times the rate of Bluetooth and Wi-Fi and 1/10 the power, and a few others. So they have long gestation periods. A couple of satellite companies, space capsule company. So it feels very different than investing in software. All the signals are different. All the KPIs are different. So it's been it's been some work to think that way, but I'm doing it for now.
Have you had to change your kind of mental model of these companies' trajectory, their capital needs, all of that stuff, which, you know, hardware, it takes a little bit more than a 15-year-old with with a laptop?
Completely, yeah. I think it feels like you need to have a little more flexibility. Well, let me compare it to something. So SaaS investors got very spoiled because SaaS businesses throw off all sorts of wonderful metrics. You know, ARR, growth, expansion, churn, GRR, NRR, et cetera. And you know, with a dozen or so metrics, you can evaluate a business pretty quickly because customers are constantly expressing their wishes and opinions on whether the software is good. So you can use that customer behavior as a proxy for the value prop. Is the product getting better or worse, and lots of things. And that's what I'm going to miss. You can't do that with a lot of other companies. And so you really have to, you know, every month after reading the investor update or a board meeting, you really have to think through, okay, how are we really doing? What do we actually know? But I guess that's why we get paid.
I hear you. For our last few minutes, I want to talk about where smart money should not be going into. What category would you guys say right now is way overexposed? Just run away from that as an investor. Don't do it. Don't write the check.
Well, again, I think the context matters. Who are you and where are you investing in the spectrum? Because again, there's a lot of opportunities. You know, most investors say, well, you know, the thin wrapper, you know, around AI that just solves a particular problem, like, you know, those all get wiped out, and we're seeing a lot of that. But again, if the context is you're an individual who understands this technology and wants to go into the dry cleaners, you know, around your city and automate them, like, you can probably do pretty well investing in that. For venture capital, I think that's going to be less scalable. That's not going to create $1 billion, you know, outcome. So I think the shift that's going on, you know, the analogy that is sort of left over from the last question that you asked is, you know, when I think about when the internet came along and I was investing in that context and experiencing it, you know, from zero to what it is today, it was so much about like, let's focus on the infrastructure, you know, the picks and shovels. That's what everybody was talking about. I think there's a similar moment now where if it's trivial application, it's not that interesting to invest in. If it's infrastructure, you know, energy, you know, you mentioned, I have a company called Level 10 Energy, right? That's used to be just software, but now it's a service that lets people, you know, contract for energy procurement much more efficiently. So I see lots of software turning into service. So just software is how I would describe it, is what you need to be running from as an investor. Just software that doesn't sell an outcome, it just sells a seat, right? Or, you know, just a layer wrapped around, you know, regurgitating something that a model is doing for a particular purpose. Again, individual entrepreneur can do really well with that for the next few years, but as a 20-year arc, less interesting today, I think.
So I've got multiple answers. In the top layer, I think there are going to be applications that are going to be mega successful, just like after the dot-com era, there was Netflix, Amazon, and many other applications that relied on the fact that other companies had built out the network. And I think that will happen. I just don't know which ones those are going to be, and I don't know how to invest there. And I think part of the problem is that the middle layer is getting getting better very fast. And so you can't really predict what mega applications are going to exist. But maybe once the middle layer slows down, you'll be able to predict it better. Then where not to put good money is forms on top of a database, as I said earlier, and data that can be easily moved out of a system of record. So something that is not a strong enough system of record. That was a question, right? Where not to invest?
Yeah.
Yeah, and then the middle layer, for me, is difficult to invest because of the reason I said earlier. I'm trying to figure out when gross margin improves. And lots of games get played there because when you train a new model, that's a huge cost. So you could think of it as CapEx, and you could say, well, that was a one-time thing, our gross margin's pretty good. But if you're going to have to keep training models, then it's not really a one-time thing. So in the meantime, the infrastructure layer is beautiful because AI is a very big budgeted customer with urgency, with price insensitivity. AI needs a lot of things, so let's make those things.
So last question, super fast. I need one-word answers from you guys. If you could only invest in one category or one vertical for the next 5 years, what would it be?
Easy, healthcare.
Okay.
We're going to live forever, you guys. Not forever, but for a long time.
Well, I don't quite know how to do this, but power and energy.
Fair enough. Thank you guys so much for being here, and thank you guys for being here with us.
Thank you.